purchases were what, beginning of the year?
Yes.
Or
Yes,
that's the time you bought into new
beginning
ideas?
Of the year.
And you bought into CapEx and you bought into few railway stocks.
Yeah, correct.
Let's understand the entire CapEx theme. And I'm keeping railways, defense aside.
Yeah.
There is a manufacturing renaissance in India. That's what they say.
Yeah.
So whether it is an area of AMS, whether it is an area of energy transition, or whether it is also in the area of EV transition.
Yeah.
What do you like within manufacturing?
Within manufacturing, I think what we have bought into is predominantly power ancillaries. Rather than betting on power generation, we have bet on power ancillaries, and I think they will continue to. They have a long growth path, so they will continue to do well.
If one looks at power, there is utilities which have done rather well, and the general view is that India will consume more power.
Yeah.
Utilities are in a good spot now. They're no longer dependent only on state government wins and FAMCs in order to revive and survive.
Correct.
Do you think one should revisit power utilities?
So power utilities have already done well, and possibly they will continue to do well because there is growth in that sector. So there is many of these companies are putting in new power plants and things like that. So there is definitely growth in that sector, and because of that, that will continue to do well. But at the same time, I'm very clear that PE expansions are not possible. So now you have to bet for what kind of growth they deliver, and then if you think that the P's are correct, you invest.
What is the benchmark you look at when you're buying a stock in terms of the growth? What is your assumption? What kind of growth you want when you're buying a stock?
So whenever I meet a company, my question to them is very simple: that you have a 7 to 8% GDP growth, you have a 4-5% inflation. So overall, there is a 12-13% growth inherent in the economy itself. So unless and until you are able to grow at 25, anywhere between 25 to 50% higher than that, I will ultimately not be able to beat the market. So anything between 15 to 20% is the kind of growth which I would like to, and that growth should be there for a longer period of time, anywhere between 5 to 8 years. So when I look at that, then obviously it's very clear that the environment should be such that this is possible, and that is the reason why I ask the companies that whether they can grow at 15 to 20%. If the answer to that is no, I mean, it's possible. I mean, there may be a very good company, like if I go and ask Hindustan Lever whether you grow at 15 to 20%, obviously they will say that it's not possible because they are deeply penetrated. So even if per capita income goes up, it is deeply penetrated. And that is the reason why I look at retail always, because long back, if you see in the US, most of these FMCG kind of companies were the market leaders, which then gave the baton to the retailing companies. And that is the reason why I think retailing will do better than these companies. But 15 to 20% growth has to be there, otherwise I'll not be able to outperform the market.
Okay. What is the P multiple you look at when you invest in these stocks? Let's say you identified a company. There are several companies in India which you can say, okay, 15 to 20%, 3-4 year growth is visible. But how much of that is in the price? How much of that is not in the price? What's the benchmark of P?
If the opportunity is such that they can grow at 20% year on year for next 15 years, then I will be willing to give a higher P. But if the opportunity, like especially in manufacturing, because we've seen that happen earlier also, 2003 to 8. A classic example, the P's went up to 60, 80, and then they collapsed. Some collapsed, some went into a time correction for a very long period. So if between 2008 and 2018, none of them delivered any growth. So it can happen that way, that they may go into a stagnation, or effectively they will continue to have their sales growth, they may continue to have their profit growth, but their stock price will not grow. So that can happen. So that is the reason why PE multiples can be different for the way the company is growing.
Fair point. Now let's look at one important ingredient, which is debt.
Sorry?
Debt.
Yeah.
How much debt levels are you comfortable with when you're investing in a company?
So frankly, if you ask me, most of the companies which we have, apart from probably Larsen and Toubro, they are all zero debt.
Okay. Is it a compulsion which you follow that you avoid companies?
So it is not a compulsion. It is not a compulsion. But what happens is that if you have a very high ROC and very high ROE, then I will think of companies with a slightly larger debt. At the same time, as I told you, we also manage a Sharia fund where there is a debt is a big no-no. So that is the reason why And most of, we also, our thought process is also that when you're looking at a company, debt is all right. But unless and until it is comfortably below the ROC which the company generates, then you buy that company, otherwise you don't buy.
If you like this video, then like, share and subscribe to ET Now.